Hello, and welcome back to Cheryll Trades LEAPS. One of the first rules most traders learn is very simple. Always use a stop loss. For short-term trading, that advice often works. Day traders and swing traders operate on short time frames. Price needs to move quickly. And if the trade goes the wrong way, exiting early helps protect their capital so they can move on to the next opportunity. But when it comes to LEAPS, long-dated options designed to capture major multi-month or even multi-year trends, stop losses behave very differently. In fact, applying short-term stop-loss rules to long-term option strategies can actually work against the investor. To understand why, we first need to look at how LEAPS actually behave. 1. The structural difference between LEAPS and short-term trades. LEAPS options are fundamentally different from short-dated trades. They are designed to capture large long-term moves, not quick bursts of momentum. Investors often use LEAPS to express long-term conviction in powerful trends like artificial intelligence, cloud computing, or digital transformation. Because these options usually have 12 to 24 months before expiration, they naturally experience larger price swings along the way. And that's important to understand. Because long-term trends rarely move in a straight line. Even strongest companies experience temporary drops. Companies like Nvidia, Microsoft, and Amazon have all experienced multiple corrections of 20 to 30% during their long-term growth. For a short-term trader, a 20% drop might mean the trade failed. But for a long-term investor, it may simply be part of the normal journey. 2. Why traditional stop losses often fail. The problem happens when traders apply tight stop losses to positions that are expected to experience normal volatility. Many traders place stop losses just below obvious support levels on a chart. Because these levels are easy to see, many traders place their exits in the same place. This creates clusters of stop orders. Markets naturally move toward areas where a large number of orders exist. And when price reaches those zones, many stop orders trigger at the same time. That creates fast, sharp price movements. This leads to a frustrating situation that many traders know very well. They get stopped out during a temporary drop, and then watch the market reverse and move exactly in the direction they originally predicted. In other words, the idea was correct, but the exit happened too early. 3. The psychological cost of constant stop-outs. Frequent stop-outs do not only affect your money, they also affect your psychology. When traders experience many small losses, it slowly damages their confidence. Each stop-out feels frustrating, especially when the market later moves in the direction they expected. Over time, this can feel like what many traders call death by 1,000 cuts. Instead of focusing on long-term opportunities, traders begin reacting to short-term noise. Emotional decisions begin replacing strategic thinking. And for LEAPS investors, this is especially dangerous, because the entire strategy depends on patience and long-term thinking. 4. A better way to think about risk. Professional investors often think about risk in a completely different way. Instead of asking, "Where should my stop loss go?" they ask a deeper question. At what point is my investment thesis actually wrong? This concept is called thesis invalidation. For example, imagine you bought LEAPS based on the long-term growth of artificial intelligence infrastructure. Your thesis might include things like rising demand for data centers, expanding cloud usage, strong growth from major technology companies. A temporary market correction does not break that thesis. But something like a major drop in industry demand, deteriorating company fundamentals, or a structural shift in technology might. When investors align risk management with the investment thesis rather than short-term price movements, they are much better able to stay focused on the long-term opportunity. 5. The best stop-loss strategy for LEAPS. Because LEAPS operate on a longer time horizon, risk management usually comes from 3 layers of protection, not just one tight stop loss. First, Thesis invalidation. The most important stop loss for LEAPS investors is a thesis stop. This means exiting the trade only if the original reason for the investment no longer exists. For example, if the trade was based on long-term AI growth, the thesis might change if industry demand weakens, company fundamentals deteriorate, or a competitor takes leadership in the market. This approach prevents investors from being forced out by temporary volatility. Second, structural technical stops. If technical stops are used, they are usually much wider than those used in short-term trading. Instead of placing stops just below small support levels, investors may use larger structural levels such as major support zones, long-term trendline breaks, or the 200-day moving average. These levels reflect real changes in the market trend, not normal daily fluctuations. Third, position sizing. Perhaps the most powerful risk management tool is position sizing. Instead of risking a large position with a tight stop loss, experienced investors often take smaller positions that can tolerate larger price swings. For example, instead of investing a large amount with a tight stop, an investor might allocate a smaller amount and allow the position to withstand 20 to 30% volatility. The total risk remains controlled, but the trade has enough room to develop naturally. Many professional traders summarize this idea very simply. Position size is the real stop loss. 6. The LEAPS mindset. Short-term traders manage risk mainly with tight stop losses, but long-term LEAPS investors manage risk using careful position sizing thesis, validation, structural technical levels, and patience through volatility. Because the biggest market trends rarely move smoothly. They move through corrections, uncertainty, and temporary doubt. And often, the difference between an ordinary investment and an extraordinary one is simply the ability to stay in the trade long enough for the long-term trend to unfold. Thank you for watching and see you in the next video.